Good afternoon and welcome to TradeStation for another of our educational webinars here at in the Omnovia services. I want to welcome everybody for attending. We have a great crowd today and a wonderful speaker. As you know, that TradeStation is a multi-asset online brokerage and trading company that's based in Plantation, Florida in the United States. And Plantation, Florida was in the path of Hurricane Irma. So even though I'm based in Chicago, many of our TradeStation affiliates and friends and customers are in the Florida area and South Florida area. And we want to wish them very well and good luck on their cleanup efforts. My name is Don Prattle. I'm the Director of Trader Development and Education here at TradeStation. And today we're going to talk about identifying momentum and reversals in the futures markets with our presenter, Mr. John Seguin of Market Taker Mentoring. Now, Market Taker Mentoring is a leading resource for option trader education, as many of you might know. But John is their head futures coach at Market Taker Mentoring. And today he's going to discuss with us how you might read the futures markets like a floor trader, as he offers a rare look at how professional traders identify momentum and reversals. All too often, traders get whipsawed by false market signals. Our webinar today, or John's presentation today, will help you avoid common pivot traps and how to recognize the trend and when to get on the right side of a reversal. As a former CBOT member, Chicago Board of Trade, and CME Group, Chicago Mercantile Exchange former broker, John will reveal his secrets to reading short-term price action so you can confidently identify when a trend is nearing its end and a reversal is imminent. The presentation today is being recorded, and we have also privatized the chat, so the questions will be identified by your presenter and me. We'll do our best to get to those throughout the presentation and at the conclusion of the presentation. The recording will be in the TradeStation archive later in the week. Let's talk about some of our disclaimers. Our presentation is for educational purposes only, and all the symbols and all the trading ideas that we discuss here are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. Active trading is not suitable for everyone, and options trading carries a high degree of risk and may not be suitable for all traders. Now, in the chat panel, we have included a couple of pieces of disclaimer and disclosure information about various asset classes. You can download those under a separate browser window and review them at your leisure, or you can review them on the TradeStation website. Also in the chat panel, there are two links. First one is to our upcoming TradeStation webcast, and also the final one is the link to our TradeStation archive in YouTube. So the TradeStation YouTube channel is where you'll go to see this recording. So today we want to welcome John Seguin of Market Taker Mentoring Incorporated as we discuss the MTM Identify Momentum and Reversals for Futures Traders. John Seguin, please take it away.
Thanks, Don. Good afternoon, everyone. Just to let you know, I have a lot of content today, and I'm going to run through it. At the end of it, I'll do my best to answer all your questions. I think it's best to just run through this content and finish it off that way. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment, opinions, market data, and recommendation. Recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. One of the things the things I'm going to talk about is something that I learned while I was on the trading floor. I was down there for about 20 years, mainly in the Treasury 30-year bond pit, but I spent some time in the S&Ps, grains, and some of the other financial instruments. My job down there in the beginning was to be basically a color commentator. And I had a headset on, and I would report price action for what was on the how much was on the buy side, how much was offered, who was buying, who was selling. When the market started trading, let's say it was 3 bid at 4, and it started trading 4s, I'd have to let my the firms, the companies we would have, let's see, in London and New York and in Chicago, in those offices, I was piping in all this information from the 30-year bond pit. Well, while I was doing that, I was also charting by hand. This was a while back, so we didn't have computers doing this stuff on the floor, but it allowed me to not only learn charting, but as I was watching the markets in real time, the auction process in its most basic form in the trading pit, I was able to learn a lot. And that information is no longer available, since probably 99% of the trading is done electronically now. I figured, how do I teach people what we saw on the trading floor? We had an incredible advantage being able to watch who was buying and selling and how much. And the order flows could really give us a good clue on reading momentum. So what I did was I came up with a way to make charts that allow me to see in a chart, or allow you to see in a chart, what I used to see on the trading floor. Now, this trader checklist that you're seeing here right now, this is a list of questions that I was being asked by professional traders on a daily basis, even hourly basis. They would call up and want to know on the trading floor, who's moving the market? Who's been buying? Who's been selling? Where's most of the trading been occurring? What's fair value? Hey, I'm in this trade. Where do I get it? Where do I get out? Where do I know I'm wrong? That's what the risk is. Timing. Is the timing right for the market to actually move in a direction, or is it a sideways trade? Where's a good place to get in or out? Support and resistance levels. And then how do I hold on to that profit with maybe a trailing stop? Or how do I project how far a market's going to go? These were the questions we're asked all the time. For today, I'm just going to focus on 2 things. And that is how you read momentum, and then how that can also tell us when a market is running out of momentum and about to reverse. Now, when I first started out, I used as many technical tools as I can. I went through candlesticks and bar charts and point and figure charts and even market profile. And when the computers hit the floor, we were inundated with indicators, moving averages, RSI, stochastics, Elliott wave, Bollinger Bands that are still popular, and MACDs, which is moving average convergence divergence. I've tried all of these tools, and many of the people that I've worked around did as well. And they all do work at some point. But to me, rather than use these indicators, it was the logic behind what was moving a market. Because I got to see what happened in a trading pit, I wanted to be able to mark on a chart when I knew momentum kicked in. And what did that look like? So here's what we're going to do. I'm going to go through a bunch of charts and tell you a little bit about how this started first, and then I'll show you some real-time charts and exactly why this style or strategy seems to work pretty well. First things first, we want to organize data, and I just want you to imagine here we're looking at a candlestick chart, and if we were to assign each half hour of the day, each one of these bars or candlesticks is a 30-minute period. And you can see how I've got them marked with A, B, C, D, E, F, G, so forth and so on. There's roughly on a given trading day, there's probably 13, maybe 14 30-minute periods during regular trading hours. So it's just a matter of marking the days. Now what I did was, so if you were to take a bar chart and just make each bar a letter, this is what it would look like. And that's nothing but a bar with letters. But if you're able to stack these on top of each other, okay, then we get a thing called a bell curve. And a bell curve is what tracks time at price. And time at price is actually a proxy for actual volume. So in other words, the more time I spend at a price here, so you see this price at 16, I've spent 8 different half-hour periods traded there. That is the high volume price of the day. In other words, it's where buyers and sellers came together most often. It's fair. And one of the things about momentum is the movement away from a fair price. So in order to read momentum, first you want to discover what fair is. Now, this high volume price tells me what the actual price that buyers and sellers came together most often. Where I have this mark where it's shaded at the price of 21 and 10 is what's called a value area. And a value area is a standard deviation of volume around the mean. I know that doesn't mean a whole lot to many of you. Think of it as it's about where 70% of the volume has occurred. So the idea being, if a market traded during the day, if a price was visited at least four or five times, that was considered part of value. There is a market profile is the style of excuse me, charting that's on the right side here. I don't use market profile, but I did get introduced to this back in the middle 80s, and it was the logic behind the tool that made all the sense to me. Not necessarily that I have to use letters, and I don't even use it. But I have found a way to actually get all the pertinent information from this tool and apply it to a bar chart. So let me show you what I'm talking about. What you're looking at here is a 30-minute bar chart of the dollar index. Each one of these or rectangles that you see is that value area that I'm talking about that covers roughly 70% of the volume. This rectangle, these value areas are outstanding for defining a risk too, but we're not going to get into that today. I use colors to help me with time, so you can see this color scale up here. Monday is purple, Tuesday is orange, Wednesday blue, Thursday red, and Friday green. You see that these yellow bars, these bars that are shaded yellow, these first bars, this is the first hour of the day, the first hour of regular trading hours. And the reason why we watch that will become apparent in a second, but you got to remember, who is it that moves markets directionally? What is it that makes markets run? Let me get used to this tool here. Okay, garbage that, good. It's institutional traders. As I said when I was on the trading floor, you have people on trading floors that are locals, guys that are just trading their own money in the trading pit. But myself, I was standing outside a trading pit, and I was answering phones and putting in orders for institutional traders, fund managers, banks, whoever wanted to trade the contract that day. It's when it's simple supply and demand. When there were more buyers and sellers, when these institutions came in, like Goldman Sachs and Merrill Lynch and J.P. Morgan, when they came in buying, the markets would go higher. And of course, if they were selling, inevitably they would push the market lower, simply because there were more sellers than buyers, or when it was going up, more buyers and sellers. Now, the times of the day, if I'm going to, I kind of think of myself as a market detective, okay? And whatever information I can possibly gather out of a chart, I want to use in my analysis. And the reason why I'm bringing up this thing about institutional traders, if they're the ones that are moving the markets directionally, I want to know when they're entering, when they're about to enter, when are they likely to be there, what are the probabilities that they're going to be involved. And as a broker, they were very, very active in the first hour of the day. First hour of regular trading hours, simply because of the liquidity. If I had a large order to fill, I wouldn't want to do it at lunchtime when there was just maybe 50 bonds offered and 100 bid. If I had to buy 1,000 of them, I wanted to do it at a time when the market was very liquid. So you see a lot of these orders, and many of my customers had what's called market on order. A market on open orders. So you will find these institutional traders very active in the first hour of the day. The next time you'll see them tends to be on an extension after that first hour. And I'll show you some examples of that. And the other thing I like to use that helps me read momentum is a little bit like a candlestick. You know, a candlestick, if it closes above the open, it's shaded. It's a bullish view, and if it closes below the open of that bar, that would be a negative bar. But I like to use close in relation to that high volume price. If momentum is the movement away from a high volume price, so if, at the end of the day, if a market closes above the fairest price, that tells me that buyers have a bit of control. And of course, the opposite is true. If it closes below that fair price, sellers have an edge. Now, this first hour of the day, and I realize that these are foreign to you, but as we go through examples, and if you have questions, please, we'll get to those at the end. But let me tell you what goes on here. So in this first hour, let me see if I can focus in on this just a little bit deeper for you. Okay. 1 second. All right. So in the first hour of the day, there's a thing called the initial balance. When a market opens up on the trading floor or even in the on the screens, the markets will go through a balancing point where you'll see a bunch of people buying. If I'm looking in a trading pit and I'm looking at all these brokers, I would see a bunch of palms. I would see the palms of these guys as they're jumping up and down trying to buy. If you're looking into a trading pit and you see their palms, that means they're looking to buy. And the market will push itself higher until it attracts sellers. That's what markets do. They move higher to attract sellers. They move lower to attract buyers. So in this instance, let's say I'm seeing it goes 5 bid, 6 bid, 7 bid, 8 bid, 9 bid, and all of a sudden the market gets up around 10, and now I start to see knuckles, meaning that the palms are facing in the pit, which is a sign that sellers are involved. Normally, on most days, it takes roughly an hour for the market to develop balance and get through these series of large ticket orders for liquidity. So that when you get this balance, and believe it or not, probably 7 out of 10 days, maybe even greater than that, that you are going to see the high or low for the day made in that first hour of trading. And it's after that first hour, how the market extends after that. And once that balance is upset, that is a read. That is another read on momentum. That tells me that the institutional traders are selling. For example, here, on this day right here, you're looking at, whoa, get rid of that. That's a little too big. Maybe use a pen. Maybe that'll work better. So right here, you had the first hour trade. Then after that first hour, the market extended lower and it closed below the high volume prices of the day. This is 3 forms of selling that institutional traders, the high made early in the day, after the market extended lower after that first hour is a sign that sellers are in control of momentum, and how the market closes in relation to that high volume price is also a sign that sellers are in control of momentum. What that tells me is that over the next 16 to 24 hours of trading, that the market is likely to be steady to lower. Meaning if I'm short, I can stay that way. That momentum is in my favor. And again, here you see the same thing. On this is a Monday. You've got the first hour range right there, extension after, close below the high volume prices. What that tells me is, first of all, the market shouldn't spend much time above that top of value area. That's one of the things I use value areas for. But it also tells me that I should expect to see unchanged to lower value over the next day, which you did in this instance. Now here's what I'm here to talk about where momentum begins and ends. So let's talk. Let me show you a couple things with that. When I see 3 days of overlapping value areas, 72-hour period. Now, you see that any of these bars that are outside regular trading hours, that's during Asian hours and during European hours. That's what that price action is. I am more concerned about the time when volume is at its highest during regular trading hours, essentially New York trading hours, okay? 8:30 in the morning, or say roughly 8:30 in the morning until 4 o'clock in the afternoon. But I've found that over time, when I see 3 days of value that are overlapping like I'm here, that a market that's telling me that a market has found fair value, and after when that happens, be ready for a vertical move. I don't know if it's going to go up or down. And I don't care. All I care about is that the market's likely to go in a direction. If you're an option trader, maybe buying straddles or strangles at this point might be a good idea. But for futures guys, for directional traders, which is most of my clients still are, they're looking for some signal to tell me that these institutional traders are coming in. And the time they come in is typically after you see a few days of sideways trade or overlapping value areas. Be ready for momentum to kick in. And on this day, you see here's your first hour trade. And then you've got the extension after that first hour. So right here, when the market extends after that second half hour, it tells me get long. Buyers are taking control of momentum. I was prepared for that because the market had consolidated for a few days prior to it. It developed a fair area. And when I see a market that's really found fair, they tend to move away from there. The same thing happened up here, where this market got all wound up here between over 3 days, these 3 days. And then what'd you do? You come in on a Friday, you had here's your first hour range or your initial balance, the extension after that, and the market went on the off on the races or raced lower in this situation. Now, what I want to do here is just run through a bunch of examples. Oh, let me tell you some of these other things that I do here. And I think as a trader, any market that you're trading, you better know the dimensions of that market. You have to know the traits and the characteristics of it. If you're going to go ahead and trade against pros, you better train like one and know what they're looking at. And one of the things that I do here, this bracket covers an average day range. This is an average week's range. These numbers that you see here, I gotta open this thing up here a little bit better. Okay. These things help me when a market starts to move away from a consolidation phase. I use these brackets to tell me how far that market is likely to go. If it's coiled up for a couple days, the move away from that should be about the length of an average range. That's what this little box tells me. That crude oil right now is averaging $1.25 a day or $2.75 a week. That's the size of the moves we're going at. Imagine when you say, hey, I've got a nice pickup of momentum, is it possible that this could be the move that moves an average week's range? So now I'm not looking just for day ranges. I'm not trying to make $1 in crude oil, but could I be, is this trade the onset of a trend where I could make 3 points? And you can see down here, that was absolutely it. I mean, crude oil went from basically $46 to $49 in a matter of a few days and equated to an average week's range. I use these brackets to make projections for both days and weeks and even months and quarters. Let's see. All right. Here we go. We're looking at gold, and this is just recently, not that long ago. I tried to put in charts in here that are very recent to show that this. I think that this method of a pragmatic approach is it works in any time frame. We're tracking who moves the markets, and that you'll get some of these indicators that'll work well. Stochastics might work well 1 week, or Fibonacci retracements another, or Bollinger Bands another, but not all the time. But I think if you approach this logically, you're going to have a pretty good idea on how to make strategy. And for gold, I can stay right here. One of the things, you see this? This is the average day range. I've got 3 days in a row with below average length ranges, overlapping value areas. This tells me that this market is ready to go vertical. Give me some signal, whether it be a low made in the first hour, an extension after the first hour, or geez, I'll just take a close above the fair price to tell me that the likelihood of the market going in a direction is higher at this point. But it really all stems from, we're talking about reading momentum and when reversals are likely to happen. There are certain things that happen when a market Okay, hang on 1 second. Not seeing where the pointer is. Okay. These 3 days right here are the consolidation. The close above the fair prices stay, and the market was off to the races. Now I'm going to go to another. I'm just going to throw out a bunch of charts here because I don't have a ton of time to do this. So I'm going to roll through these pretty quickly. Here, when I tell people my class in my classes every day that the markets do two things: they rest and they run. So we have to figure out what cycle is likely. And here we're looking at gold, where you had 4 days in a row of basically unchanged value areas. We get these things that are called sprints or single prints. You see this really low volume? Hey, if what's the deal is if a market spends more time at price, the time at price, time plus price equals value. Well, what happens when it spends no time? That means that means that people are really looking to sell in a trading pit. When this move here, after this rest period up here, this move down, this sprint, what I call single sprints, those happen just about every single trend I've ever seen. They happen very early in trends. So when you see 3 or 4 days of overlapping value areas that are below average, be prepared for a vertical move. And you see a sprint, you hop on that trade. Markets rest, then they run, then they rest again and run. Another reason to think, okay, well, I'm not going to get into overbought and oversold. Maybe we'll do that on another day to tell how far when a market's really ready to change direction. But that's all they do is they rest and they run. And so be prepared for momentum to kick in when you get about 72 hours of regular trading hours overlapping value. Okay? Now, here we're looking at the NASDAQ future. This was a little while back, but I thought it was such a great example of how that market had below average value areas over a 5-day period. And you think about it this way too. Sometimes, if let's say you coil up or consolidate or rest for 3 days. Well, what if you do it for 5 days? I think of these consolidation periods as the time a market is building pent up energy. The more time it spends at price, when it releases that energy, the move in a direction or the vertical move is going to be quite a bit larger than normal. Happens all the time. And you can see here with the NASDAQ, when it went up, you had this buying right there. There's that sprint. And this market went on a run and it stayed above previous value areas the whole time. So if I were long this, my stop would be there. Then the next day I'd move my stop there at the bottom of these value areas. As the market's moving in direction, I use these value areas to define risk. It's a great way to trail stops in a position. Now, how do I know when that's going to end? That's the next question. All right, so we've got a trend. This market just moved an average week's range in a matter of days or a few days or a month's range. How do I know when it's going to end? There's other types of price action that occurs when a market's run out of steam. You know how I said when it's moving in a direction, the market will, it'll make its low. And for instance, if it's railing, you'll tend to see lows made in the first hour of the day. You tend to see extensions higher after that first hour. You'll see closes above the fair price of the day. But when a market's ready to roll over, what you'll see is what you see right here on this day. The market, after that initial balance or that first hour, it extended both higher and lower. That's a sign of neutrality, that maybe this market has gone high enough to attract sellers. Also, what you tend to see is when you see a whole day's range like it did this day, the whole day's range was done in the first hour of trading. That's a sign of a market that's a little tired of going in a direction. And then you get the overlapping value, and there you go again. A high made in the first hour, extension after it, and you go on that sprint down. So this market told us it was wound tight, that there was change coming, and it came. And it moved an entire week's range in one day. This just happened, late last month, late in August. This huge move down on a Thursday afternoon. Now, what happens after that is another reason to look at these brackets. This market moved a whole week's range in a matter of a day. To me, that's a market that's really oversold and not likely to keep going in that direction. It's gone too far too fast. And that's for another presentation. We can talk about how you rank what's gone too far too fast. But as I said before, markets will go in a direction to search for buyers. And how do I know when the buyers came in? Well, now I'm seeing the highs or the lows made in the first hour. Now I'm seeing extensions higher. That tells me that there's a change in momentum, that the market has cheapened enough to attract a buyer. So as the market's trending down, you tend to see highs made in the first hour. Extensions after that first hour are lower. Closes tend to be below high volume prices. They go a little too far too fast, then you'll start to see, oh, wait, buyers are in. They consider this market cheap. 2 days in a row, the lows were made in the first hour, and then the market took off. It told us that buyers were starting to take control of momentum in this instance. Here's an example of natural gas, and this was not that long ago. This was in early August. The pent-up energy that it had over a 6-day period of far below average day ranges. And look what happened. A whole day's range done in the first hour. I got a neutral day here, meaning it made a new high, a new low after the initial balance. Now I'm seeing lows made in the first hour of the day. And when it broke out hard. Here, buyer. There's a thing called initiating buyer. When I see, think of it this way. When a market gets above fair value, as I said before, it's looking for a seller. What if the first action you get is the buyers come in? If I'm looking at a trading pit and I'm seeing, okay, this market, natural gas is above where value's been for the last couple of days, the first thing I should be looking in the trading pit for are palms, thinking that people want to sell it. And the first thing I see are a bunch of, I'm sorry, I should see a bunch of people, I should see their knuckles, meaning that they're trying to sell in the pit. And the first thing I do is I see their palms, that everybody, it's above fair value and they're still buying it. That's a powerful, powerful statement of the market. So I'm constantly asking whether a market, hey, it's above fair value. Are the sellers showing, are they there? If I'm not seeing a low made in the first hour, or if I'm not seeing a high made in the first hour, or I'm seeing an extension up, that means this market is going to go higher in search of those sellers. There are subtle changes that you see, as I mentioned before, when you see, I'm just reviewing here. Those neutral days, when a market's ready to stop trending, you will start to see neutral days where you get extensions after that first hour, both above and below. Where you see a whole day's range, and the market's made a whole range in the first hour of the day. That's a sign of a market being tired. And then, how the market closes in relation to the fair price. That's another sign for reading momentum. Moving along. This was a great trade. This is cotton. You can see that the 3 days of overlapping value area and then that big old sprint down. As soon as that market extended after that first hour, it just never looked back. Now I want you to look at what's going on here. High made in the first hour, high made in the first hour, high made in the first hour, high made in the first hour. Neutral day. Neutral day. End of trend. Sprint. Market takes off again. The markets will give you, listen, it's about reading market-generated information. The information that we need is there. You just have to learn how to read these charts and understand what exactly is going on here. And listen, if we want to be trend traders, you're going to have to find a way to ride that wave with the where the institutional money's are, where the capital flows are going. And sometimes the capital flows, we will know, or at least get a hint that they are about to enter the market, and it usually comes after a period of 3 days of consolidation. Be prepared for that, especially if that consolidation is severely overlapping as far as these value areas go. This is something that I work on every single day in a class that I teach, that, by the way, is recorded. We go through this stuff every day. And I'll get into it a little bit more, but it's the same thing every day. Right? When I was on the trading floor, I could trade bonds, or I could trade 10-year notes, or maybe the S&P, because that was the pit that was in front of me. I think when it first came out, the electronics, who needed brokers anymore? You could have your exchange right at your desk. At first I thought this is terrible, and then I thought, wow, what a luxury to be able to, rather than have to trade future or treasury futures, let's say. Now I have the ability to trade gold, S&Ps, metals, grains, energies, softs. I can trade anything on earth, and I don't have to have a connection to a broker in a pit to get an order filled. And that's when it dawned on me. Well, why not just look for markets that make sense instead of trying to make sense out of a market that doesn't? In other words, I'm going to look for a couple patterns that I know pay off, or the probabilities are high for a market moving in a direction. So I will search high and low for markets that are wound a little too tight over a 3-day period, or markets that are showing me that they've gone higher, and all of a sudden here's the Dow and it turns into neutral. We got a neutral day right there. Whole day's range done in about a first hour here or here. This market's tired of going higher. That's all I know. Does it mean to just go right out and get short? No, it means that it's probably going to have the upside's going to be limited, and there is that chance that it will reverse. And you can see here that it had an extension after the first hour. This is telling us that sellers are starting to take over. Here's gold before it took off. You can see that it had far below average range. Now look what it did when it topped out. Far below average range here, a little overlapping. There's that sprint, and the market went on. Look what happened when it reversed. The whole day's range done in the first hour before it reversed. These things repeat. I believe that markets or patterns repeat in all time frames in all markets. It's our job to seek out when the opportunities present themselves. And here you can see this is crude oil for when it was hanging around $50, and this was not that long ago. That was early August, right? You can see all this pent-up energy that it had here. And then after these 3-4 days of consolidation, we got a nice little sprint right here. And I want the next screen will show you what happened thereafter. It was down another sprint. Sprints are single prints. Oh, by the way, these sprints, outstanding support or resistance when you revisit them. So here's a sprint where the market, think of it, this is where the market, where sellers just, everybody's jumping up and down trying to sell. Trying to sell, and there's not a buyer in sight. That's what those single prints are. You see those all the time right before a market busts free. And look at when you came back to it. 2 days later, you came back to where that market, think of it this way, this is where sellers really poured it on. The market came back there. That was resistance again. Then you had another sprint down. And a week later, you came back up to there, and that was a resistance level. And here you had a little sprint up. After the market went down, had a neutral day, low made in the first hour, extension up. This market is turning. It told you that. And then it sprinted up. And look what happened. The next day you came back, and that was the low for the day, right where it started. This is what I'm talking about, reading market-generated information. If you know where sellers really came in hard, believe me, when you come back to that, like right up here, they'll show again. Most of the time, if you're looking for support or resistance or levels to set your trades, refer back to these old sprints, and you'll find that they're outstanding levels for picking support and resistance. What you've seen is I'm organizing data at what I call a pragmatic approach. I'm taking every bit of information. I'm not talking just about the vertical measurements of the ranges, the highs and lows, but I also track time at price. Because the more time at price, the market I think of it as getting wound up for a big move. And I use, within the charts here, all these elements are there, and it's a matter of how you're going to use them to your advantage. So what I've talked about is just how you look at it from a day perspective on how you might be able to tell when a market is about to move in a direction. Here, what we're looking at are weekly profiles. Now you see that the scale is the same, that Mondays are still purple and Tuesdays are the same color. They're very consistent. And even in my monthly profiles, it's that same color scale. This way I can look at these charts and I can see time. But now I'm not talking about how much is the market going to move by a day, but maybe instead of capturing a day range, hey, this market's awfully wound up. Now I'm seeing a buyer above the high volume prices. Let me get rid of that. That's pretty ugly looking thing there. Below average. Market closes above a high volume price of the week now. Here it was closing below the high volume prices of the week. I got a neutral week here. Think of Monday and early Tuesday, say, as your that first hour. Same. We're not going to change the way we look at markets. We're just going to change time frames. So now I know that when a market is turned over neutral, now I'm seeing buyers above value, a close above a high volume price. This market's far below average range. Tells me that get ready, there's some pent up energy. And of course, there's one of those sprints again where the market takes off. Now, after a market sprints, goes through a consolidation phase, 3 weeks in a row, goes above a high volume price, extends higher. So now instead of looking for an average day range, now I'm thinking, oh boy, could this be the start of a trend that could last a week and possibly a month? And that's precisely what happened here with the euro currency, where you had 3 weeks in a row of almost identical value areas or high volume prices, and then the market took off like a banshee for 3 weeks in a row. A sprint is something you see at the beginning of a lot of charts, and I want you to think of it as in these. Well, let me go back a little bit. It's so important that you understand that concept. That a sprint is simply, I made this up as sprint. The market actually is sprinting away from value, but it's single and prints put together, a sprint. And they're these low volume spots in the day that tell you that a market's on a run. These things that a market has really gone, well, about to go ballistic. Here's a perfect one there. All right, let me go back to where I was. Okay, so here we're looking at, this was a really nice little trend. So we talked about the euro. We can get rid of that one. Let's take a look, and here's copper. What a beautiful setup. This is what I do. I have this software that I developed, and this is what I use it for every weekend. Even often during the week. When I see something like this, when I've got far above average time at price, in other words, this bell curve has spent too much time at price and is far below average vertically, that it's time for a sprint to come. When I see something like that, I better be ready for a direction or a breakout. Even on a smaller scale, you saw it here. This one, far below average length, far above average time at price, and the market went on the run again. It's about probabilities, folks. Markets run and they rest, or they coil and they trend. What you have to ask yourself, what is the market likely to do? Here we've got a market that sprinted up, and now it's been 2 weeks getting rid of an overbought condition. I've got an ample amount of time at price, and I get a sprint away from it, and that started a 5-week, 6-week trend in wheat, simply by knowing that this market was wound a little too tight. And heck, even if you missed the trade then, you're still getting close below the high volume price, close at the high volume price, close below the high volume price, close below the high volume price. This market has, each week you want to think, and it's closing on the lows of the day, sort of like if it closes at the, or it's closing at the lows of the week. The highs are being made in the first day of the week. When the trend changes, you will see. How do I know when the trend's going to end? Well, all of a sudden, we're going to start to see the lows being made in the first hour of the day. So while the market's trending lower, I use these longer-term bell curves, and then when I've got an idea that, hey, could this thing be turning over, I go to those short-term things that I was telling you about. Hey, are the lows being made early now? Well, if they're not, then this thing's probably not done. Did I see a neutral day? Hey, that's a sign that the trend is ending. Did they close above the high volume price of the day? Oh, there's another sign. So I will continue to ride a trend as long as I can until the market tells me that it's gone low enough or high enough to entice a buyer or a seller. I told you this before, patterns. This is the S&P, but now here we're looking at months, folks, okay? Instead of just days and weeks, we look at months. So I look at these patterns in 3 or 4 different time frames. I even look at quarterly charts. But you can see here, the S&P typically has a much larger range than this. This is January. Look at all the time at price that it spent. More time at price means more pent up energy, and then in February it took off hard. Then it rested, and it took off hard again. And here the market's still in a consolidation phase. I mean, it's been going higher pretty much all year, making new highs now. Not once has this market been able to close below a previous high volume price. So why would I think that there's an end to the trend? Oh yeah, it'll stop and pause and relieve overbought conditions, but really from short-term and long-term looks, there really hasn't been a great sign in equities to be short for any length of time. And now I want you to look at these are quarterly charts of the S&P, or quarterly profiles. And I use these for perspective. I like to know, okay, so here's this year. This is January, February, March. You can see that I'm still using January, and Mondays are the same color, and Tuesdays in February, so forth. So I'm reading time here. So I've got January, February, March, April, May, June. They just continually is closing above the fair prices from even the previous quarter. So what I would like to think before the S&P or the equity indexes are ready to turn over and go south, that not only will I see a bunch of charts, a bunch of neutral days and things like that, but now we'll start to see closes below weekly high volume prices and even monthly high volume prices. And until that occurs, this trend is very much in hand. I'm running through these things too because I got to get to the end of this. One of the things I'll leave you with, I made this acronym that I call Vertex. And Vertex covers all the questions that professional traders would ask me all the time. And it's an easy thing to remember. And if you cover these 6 components, you will become a better trader. You need to know what value is, because if I can't read what momentum is or the energy of a market unless I understand what fair value is. Once I get in a trade, I need to know immediately what that risk is going to be. In other words, when does the momentum change? If I believe a market's going to go higher and it changes, there's a change in momentum, then I'm out. I'm off. I'm wrong. Nothing wrong with not having a good trade on. It's going to happen. It's recognizing when you're wrong is what matters, and taking that. Timing. Is the market ripe? Is it wound up tight enough to release that pent-up energy and run? Or has it really overbought? Has it moved a month's range in a matter of a week? That's a market that's overbought or oversold. Where are good places to get involved? Typically, great support resistance levels come from old high volume and old very low volume prices, as I mentioned, the sprints. And when I talk about exit, is how far is the market likely to go when it leaves? Is it likely to move just a week's range, a day's range, a week's range? Is it possible that could be the start of a trend for an entire quarter? And how do you protect those profits you're in a trade as the market's moving in a direction? These are some things that we go over every single day in our classes. And we cover equity indexes, interest rates. So we've got the Dow, NASDAQ, and S&P. The interest rates, we have 5-year note, 10-year note, and 30-year bonds. We look at the metals, in particular gold, but we look at platinum and silver and even the base metals like copper. Energies, particularly we go with oil and natural gas. Foreign exchange, so you got the dollar index and the currencies. We'll take a look at grains, livestock on occasion, the softs like coffee, cocoa, sugar, OJ, and we certainly look at ETFs. Hey, if you can't open up a futures account because it requires some margin, and especially if you're going to be carrying trades overnight, it's not cheap to do that. But you can trade a lot of these commodities using ETFs, trade the directions. For instance, gold, the GLD ETF, USO if you want to trade oil, TLT if you're trading interest rate products. So there are ways to play futures moves using ETFs. Okay. Well, I'll get to questions in a minute. I just want to tell you what this is all about. So I'm going to talk to you about your trading to the next level. If you want to learn to trade and really learn to track markets consistently, you're going to have to come up with a method that allows you to see what professional traders are tracking all the time. So it doesn't have to be complicated. This is a very logical approach. We are breaking down days just like a professional would. And so this, I work for Market Taker, and they're mainly they have an options group. They brought me in to be the futures guy. So every day at 10:30 Central Time, 11:30 Eastern Time, I have a class, and it goes for an hour, and we look for trades in many markets. We look for the patterns that are making sense to us. And so we try to get rid of some of the guesswork and work probabilities in our favor. So you can trade, once we understand value, maybe we can help you really do well with calling for breakouts, or actually telling you when it's probably the best to be out of a trade that you've been in for a while because it's exhausted. Okay, so this class that I'm talking about, by the way, this class is recorded every single day. So I understand that many of you can't go to class, but it's by probably 1 o'clock in the afternoon every day. I believe it's on the website so you can review it, or if you want to do it at the end of the day. But this is not for people. If you're looking for if you're looking for a more consistent way of trading markets, I can help you with that. If you're looking for more winners, we will look for those setups, and it's just a few steps that we have to go through. And if you don't have this approach, you're just, well, you're not going to be able to battle with the greatest traders on earth. This puts us on the same playing field as them. This is not, if you're here to catch that one trade, it's all that's going to make you retire. That's not what this is about. This is for people that want to get involved, that want to trade, that have the time to get involved. And even if you don't have the time, at least maybe you'll be able to look at the markets and to find out when the timing is right for you to be involved. You don't have to be trading every day. And this is certainly not a Band-Aid. It requires homework, but I do that for people, and I'll show you easy ways to mark your own charts. All I simply use is a tool that makes rectangles. That's it. I don't need market profile. I just use bar charts, and I use colored rectangles, and that's what I use to do my homework. Okay. Now, okay, so here's the idea. When I have this class, you get somewhere between 3 and 5 trade ideas every day. We cover all the indexes. I mean, all the major futures contracts. You've seen that it's on at 10:30 Central or 11:30. That's wrong there. That's 11:30 Eastern. The classes are recorded. If you miss one, you can always come back and review it later. I'm open to questions in class. It's very, very important for me that you understand exactly what we're doing, who we're searching for, how we're reading momentum, how we're defining risk, that vertex. And we will cover that on a day-to-day basis. And it may take you a couple months, but I think once you're in class for a little while or go through some of these lessons, you will become a far better trader. Now, if you're interested in the classes, I want you to take down this, markettaker.com FCM. Go to, or FC99. That's markettaker.com FC99. Let me tell you what it's all about. So we have incentives today for discount renewal for life. It's at $227 a month. And you get an intro to futures trading book and impact videos. Again, markettaker.com FC99. And here's what it is. You get 1 month free trials of futures. So for the entire month, you can come to class or get the recordings. Normally at 332. We have the Impact series, the Futures Impact series of videos that you will get. You get to go into the chat room, which, by the way, is pretty good. There's a lot of really good traders in there, both options and futures. Great chat room to listen to and get involved in. You get to use the software that made those colored charts that you saw, and I will show you how to make them. There is a lot to them. There is incredible amounts of information that go along with that charting software. Normally, that's $100 a month. And then you get a free market profile boot camp webinar, which is basically what I'm telling you about. I'll show you how to use the software and how to make it a good tool and put it in your repertoire. All that would normally cost $13.28. We're going to give it to you for $99. And all you have to do is go to markettaker.com, FC99. You get them, if anything, just the group coaching for $100 or $99 is worth it alone. But they have all these other things involved with it, including getting to use the chart software, and I'll teach you how to use it, how to read markets like a professional, how to find all those little nuances in short-term charts that might enhance your timing on when it's time to hop on a trend. If we keep doing this on a day-to-day basis with a consistent approach, you will be a better trader. Because if we show you how to track value, understand or read momentum when it kicks in, how to define your risk, how to figure out if the timing is correct to actually be in a trade. Is there any direction likely? If there's not, why be involved? Now, there are trades you can do that. If the market's not going to go in a direction, you can certainly sell volatility or sell premium and somehow maybe make some money while there's time decay, those kind of things. Oh, sure, there's optionality in this stuff as well. And, of course, the boot camp webinar, which is really all about teaching you how to use the tool itself. So there you go. That's so if you're interested in this, give it a month. MarketTaker.com, FC99. Give it a shot. And I'm open to questions and tracking any market that you like to trade, and even in stocks. I'll look at stocks for you. We do check out stocks often, and the students seem to really, really like it. So again, markettaker.com/FC99. This is Market Taker Mentoring. If you want to take a look at the website, go to Market Taker Mentoring and check it out. Especially if you're interested in options. This company started with Dan Passarelli. He's an outstanding options teacher and trader. And this is his company. He's been doing it for about a decade now. I'm new to the group, but the options and futures guys, we have it all there for you. And one more trial futures group coaching. Yeah, all those things. 1328. Just reviewing that. 99. Okay. I did it in just about an hour. Now I've got. I thank you all for coming, and I hope to see you sign up and get into learning how to really read these markets. Are there any questions out there? Don, did you see any out there that I could answer? Or I really didn't have a chance to follow.
Okay, so I do have one. Way back, Pamela had one while you were on the detective slide, and she was saying that you say value area is the first hour, but you were showing 30-minute charts. Could you explain why?
No. Yeah. The value area actually is the value areas that I use, and maybe I can go back to the beginning there just to see if I can start this thing. Sorry about this, folks. Nice one. Value areas for me are the areas that cover a standard deviation of volume, which is roughly 70% of the volume. I have looked at so many bell curves in my life, hundreds of thousands. And I found that really most value areas, the way they're constructed, that if a price had traded in 4 periods that day, 30-minute period. So each one of these bars is a 30-minute period. The yellow bar you see covers that initial balance, which is the high volume time of the day or the most liquid time of the day. The value area are these colored boxes that cover 70% of the volume. And there you see that the top of that value usually has about 4 prints in it, and the bottom has about 4. Then it traded in 4 or 5 different half-hour periods that day. That's how I construct them.
Okay.
And that allows, you know, when if you come to class, this was more about reading momentum and finding out when a market might be ready to stop trending or when their reversals might occur. Well, we talk about risk. We talk about all those things I told you about in Vertex. We cover everything. You just this one just happened to be about reading momentum, and because it's really what we're trying to do is spot where the institutional traders are, which way they're leaning. And as a floor trader, you want to maybe counter trade that thing, but as an off the floor trader, ideally we all want to try and ride trends. And this, I think, helps us prepare for when a trend is ready to start.
Okay.
At
So
least we can get that out.
I think Carl asked a question that you may have already gotten to, where he was asking you how to define a sprint. And it looks like some sprints occur over several days to him.
Yeah, I mean, once a market gets going, often you will see consecutive days of sprints. So to me, a sprint is something that usually happens midday, in the middle of a day. So a low volume, like right there. Let me erase that here. Just point them out to you. Funny enough, you tend to see sprints. Another thing that I watch is the first hour range, and if let's say the S&P averages 8 points in the first hour every day. Then I see a range, the first hour range is only like 4 points one day, and it happens to be after a period of consolidation. So if I get a below average first hour range after 3 days of consolidation, when that market releases its energy, it tends to go hard and fast and leave these sprints behind. And sprints are these like really low volume pockets that markets leave behind when they start the trend. Let me see if I can find another one for you. Yeah. Like here, this is a very powerful one right there. Look at this, right there, that sprint. They just happen a lot when a market starts going and it turns. And here, when the market reversed up, you got one there. They don't happen a lot, but they typically come after you see neutral days, markets that coil up or consolidate or rest for a few sessions, then be ready for them. And when you get one, that's a sign, Bob, okay, I got my answer.
So
you got your answer and direction.
the right about then, about the same time that question popped in, Lee had a question about discussing underlying cash, how the underlying cash market determines future price. As a, well, it makes it, it's a component, but
right. So what's the question?
The question is, how much of a component is the underlying cash price to the futures price, Sean?
Yeah. I guess I'll just be honest with you. I only look at futures. I mean, I do look at the indexes, but I don't look at underlying. I used to when I was on the trading floor. We had a machine called a Bloomberg.
Sure.
And there we could see all the Treasury instruments, 5-year notes, 10-year notes, all the ones that the government had released. I mean, every single one of them. But they are, what is it called? God, it's been so long since.
They're just indicators, as I think you're pointing out.
Yeah.
And they.
Yeah. In general, the futures can probably give you a better move on really where momentum is. It's so hard to watch all those cash instruments. Oh my gosh, when you come to treasuries, think about the treasury pretty much auctions off every other week now, like 3-year notes, 5-year notes, 10-year notes, and then another week they'll do 5s, 7s, and 30s, and they are constantly throwing supply out there. So those underlying instruments all generally, I think, futures will move in the same direction of if you're watching a 30-year bond. you know, going to look at the long end of the yield curve, and 10-year notes middle and 5-year notes in the front. They're all affected differently. If the Fed is on going to be raising rates, well, the 5-year notes are probably going to be affected quite a bit more than the 10s or 30s. Yeah, it's difficult for me. Yeah, you can look at the cash instruments.
Sure. The underlying to the.
I get to see volume. When you look at cash instruments, you don't get to see the volume at those instruments, I don't think. But in futures, at least I get to see if the volume's picking up as the market is moving in a direction. And I've just been a futures guy. You know, I don't really watch the cash that much. Futures are good enough for me.
The Pamela wanted to know if you trade soybeans.
Sure, absolutely. When the pattern allows, sure I do. I'll trade anything. I have an automated system that I've developed that gives me signals and say, hey, I've got some 3 days of overlapping value in cotton, or it doesn't really matter what commodity it is. The system is built on telling me when to prepare to trade a market. So it could be beans, it could be S&Ps. It really doesn't matter to me. As I said, I look for markets that make sense to me and trade those, rather than just to say, oh, I'm a 30-year bond trader, and there are days that I didn't have a clue what to do.
Okay.
And I think that that's the great thing about electronic trading, is that you don't have to be held to just one market. You can look at 30 different commodities and figure out which patterns make sense to you and trade that one.
The Carl had a question about the each colored flag, and I was pointing out to him that you had a color code for when you were talking about weekly patterns that displayed each day separately, and then when you switched over to the monthly, you showed weeklies, and then when you switched over to quarterlies, you showed monthlies. And maybe you could elaborate on that.
Yeah. All right. So you can see that the color scheme I have here, that each day of the week is shaded these colors. Now, also, this same color is the first day of the first week of the month. When I look at my here, let me just get to that. I'll show you. So we go. So now you can see that Mondays are still purple. You see the same color scheme works here. Mondays, Tuesdays are orange, Wednesdays, that's always the same. But now if I go to a monthly profile, get to the monthly one, then it's the same color scheme. So rather than Monday and week 1 of the month are the same color, and Tuesday and week 2 of the month are the same color. This by looking at this and developing this way, it allows me to scan daily charts, weekly charts, monthly charts, and even quarterly charts, and be able to read momentum in a moment, in a flash, and literally I can go through 25 or 30 commodities in less than 15 minutes and get a good idea on each one of those. That's from training, from doing it every day, to tell me when these opportunities show up. So it's a matter of scanning. If I have a consistent approach using colors the same way, that I'm able to really notice patterns very well. And here's the same thing here. So where Monday, first week of the month, are this color purple, so is January. And then February is the same as Tuesday, or the second week of the month.
Okay.
And so forth and so on. And you can see when I get to June, I've got variations of that. So it's still purple, but just a lighter purple. It just really helps me read time. And I'll tell you another thing that it does. When you're looking at correlations with markets and patterns and trying to match patterns, for instance, the way 10-year notes and gold are trading right now, and the yen are very highly coordinated. Are correlated. They're considered safe haven investments when there's turmoil. So when we had the deals going out with North Korea and such, and that these markets were making their highs at the same time, I'm noticing, geez, that they're all making their lows on Monday mornings and they're making their highs on Friday afternoons, and then all of a sudden it switches over where gold made its high on a Wednesday, so did the 10-year note, so did the yen, and they all turned over. So these colors also help me with pattern matching as well, and reading correlations. incredibly helpful for that too.
So let's see, what was another question that I thought would be very, is this applicable to stocks, and how do you define value? Those were two questions side by side.
Yeah, yeah, I think, well, it certainly does pertain to stocks. I mean, it works with ETFs. I look at it with stocks just a little bit differently. I like to look at quarterly profiles when I look at stocks, um, because that's more of an investment to me than a trade. But it doesn't mean that it doesn't work. Heck, I think the consolidation periods in stocks might take a little bit longer rather than maybe a 72-hour period. You might want to look at a whole week.
And I think
overlapping value areas.
I think John, to everyone that's listening, John's expertise is in the futures markets, and this product, his package has been created for futures products. So he's modified it at times to mimic the way that the futures indexes for equities move around. It may not be exactly the right correlation to an individual stock, but it could be close. Is that fair?
Yeah, I mean, you know what? Don, last week I made quarterly charts for the Dow 30, the Dow 30, thinking that okay, I'm looking at quarterly bell curves, and if I could see that, well, when I did this a month ago, I saw that just about every one of them was closing above the fair prices of not only the month and the quarter, but then all of a sudden I'm starting to see a couple of them. So of the 30, instead of just 2 of them looking weak, now there's like 5. And I'm wondering, is this predicting some change not in the not too distant future? So yeah, if I wanted to trade an index and the underlying of that index can give me a clue, heck yeah, I'd use that in a heartbeat. So on occasion I do look at the Dow 30 from a longer term perspective to see if there are any long-term changes. In other words, is the market closing below a quarterly high volume price or a monthly high volume price, that kind of thing.
All right. So one more question about the concepts, or actually 2 small ones. Do you use an average holding period for your
No, I don't, because I think about it this way. Yeah, that's a good question too. Often you could say, okay, I think there's enough pent-up energy maybe to move a week's range, but what if you move a week's range in 2 days? I've already got my objective, so I'm not going to say it. Yeah, I'd like to think it's going to take a week to move that far, but if it moves as far as I had planned in a matter of 2 days, then it's a 2-day trade.
Right.
By projecting how far a market's likely to go, if it gets there too far, too fast, if it moves too far, too fast, it's likely to go to a holding pattern. And let's say it would limit my upside while the market goes through a holding pattern. So it really is more about the length of the move and not so much how much time it takes to do it. Because when markets release a lot of pent up energy, it could move a month's range in less than a week. So hey, my goal is to make a month's range. If I got that in a week, I'm off the trade. So I don't want to put time factors on it. Sometimes it's good too, but it really depends on the speed of the move once it breaks free.
Got it. So let's see. Just one more. I know it's dinner time. We have to get moving on for folks on the East Coast and certainly those of us in the Midwest. Sylvia has asked, how can you go back in explaining how do you get the overlapping price?
Well, simply, let me see if I can find. Yeah, right here. This is a good example. You see here, I got the top of value here, so it overlaps this day, So the top of value from this day, the middle value from this day, and the bottom value from this day, there's overlapping of these 3 days. That tells me a market's wound a little too tight and probably going to go vertical. Whether it's up or down doesn't matter, but the point is that shows me a sign of tightness. Just like it did down here, you had 3 days of overlapping value before it took off on a Friday afternoon here and went ballistic.
Now,
So it's these value areas if I see overlapping like here, right there. There's 3 days of overlapping.
so John, there was one, we had a question too about the software integrating with TradeStation. So in terms of charting, when you mentioned to me early, because the answer is that John's product is not offered as a TradeStation App Store tool at the present time. So you mentioned to me that all somebody would have to do would be draw boxes on various charts. Could you simplify that a little bit? It sounds pretty
Yeah, you know
simple.
what, Donnie, I know what. Listen, I have gone through a number of different platforms and stuff like this, and I chose the one that I chose just because I liked their data. But in your toolboxes, in most charting packages, you will have tools there where you can draw lines, trend lines, and all those other things. You have text boxes you can put in, like these down here, where I'm tracking average moves. So the tool that I use is simply a box or a rectangle. It's usually it's usually in most charting packages where you can. This is what I do every day. I make these boxes. I just go to my software, hit the box, make the rectangle, color it, and I do that for about 30 or 40 commodities a day. I'm watching markets all day long, so I'm able to keep up with this. I'm writing newsletters for people that want to look at trades for my clients. So I'm on this all day long, and it does take a lot of homework to do all the commodities that I'm watching in the ETFs. But it is a full-time job for me.
Absolutely.
And it's basically coloring every day. Just a little bit of coloring and to organize the data. And that's really all it is. And I think within 10 minutes a day, you could probably do 10 markets. Maybe 15 minutes, but I think that's all the homework it would take.
Thank you very much
And of
for
course, this is something you would learn in class. Yeah, in class we go over this a little bit deeper, and I show people exactly how to do that.
Well, I want to thank you, John Seguin of Market Taker Mentoring, for spending almost an hour and 15 minutes with us today. You went way beyond the call of duty, taking everything into context, ladies and gentlemen, that we've been talking about over the last hour. You're picking up, I think, that it's very important that you consider your outlook for the market when you're choosing certain strategies. Take into consideration overall market sentiment when you do choose those strategies, and use tools like ours at TradeStation and with support from whatever source, perhaps Market Taker Mentoring if you choose to do so. Finding profitable trading opportunities can be hard no matter what the market is doing. So that's why we bring forward professional traders like John Seguin to help us so that you don't have to do all the work yourself. Remember the offer and the access at Market Taker Mentoring, and please have a good evening, and we'll see you in the morning for the morning market briefing here at TradeStation. If you're available 1/2 hour before the market opens here at TradeStation, please join us for the morning market briefing. John Seguin of Market Taker Mentoring, thank you so much for your time today, and we hope to do this again sometime soon.